Thank you very much to the Knight Frank Nairobi team for inviting me to speak today at your event. I'm going to spend about 10 minutes outlining the key findings from the Wealth Report 2023, which is our 17th edition. As a bit of background, I set up the report back in 2007 when I saw a gap in the market for insight on private capital and its relationship with property. Wealth is an often controversial topic with issues around taxation, fairness and inequality front of mind for many commentators. We've always taken the view that as private capital becomes more important to the world of investment, then for investors, policymakers and journalists, it's increasingly critical to understand how this money has been deployed, where it's originating and where it's moving to. A lack of understanding of private wealth means a partial view of global real estate markets, and that's the knowledge gap that the Wealth Report attempts to fill. So let me begin by giving some context to this year's findings. Last year, the Ukraine crisis fueled an energy crunch in Europe and it acted to boost already surging inflation. As a result, 2022 saw one of the sharpest upward movements in global interest rates in history, leading to economic conditions which were neatly dubbed the perma-crisis. Now, significant risks remain for the global economy. Inflation in major economies is above target, interest rates are still rising, and consumers are facing a serious cost of living crisis. But in this year's report, we argue that investors should look beyond those risks. As the interest rate pivot approaches, maybe later this year, we believe that market sentiment will shift quickly and investors need to be well placed to take advantage of the very real opportunities emerging across global real estate markets. Let's think about wealth. Looking at the results for 2022, challenging conditions meant that the majority of ultra-high net worths saw their wealth decline last year, with their collective wealth falling by 10%, equivalent to $10 trillion. The epicenter of the crisis, Europe, was at the sharp end, with an average 17% fall in portfolios, while Africa demonstrated the most resilience with only a 5% drop. In a sharp reversal, 70% of global wealthy investors expect growth in their portfolios this year, with confidence driven by asset repricing, perceived value opportunities, and an expected economic rebound. This newly minted wealth will be put to work with investors targeting capital growth, confirmed by 31% of our respondents to our attitude survey, capital preservation, 26% of respondents, and income generation, 23% of respondents. So we expect increases in investment allocations this year, with almost a third of investors looking at property investments to provide an inflation hedge and diversification. If we turn to commercial property investment, more expensive debt and heightened uncertainty saw investors retreat in the second half of last year. While institutions reduced real estate investment by 28% in 2022, private capital was less defensive, falling only 8% and accounting for a record 41% of the $1.1 trillion committed by all investors. Private investment was dominated by allocations to residential, 43% of the total, offices, 18%, and logistics, 15%. While US cities led in terms of volumes, London took the biggest share, 15%, of cross-border investment, followed very closely by Singapore. African markets in demand were led by South Africa, Kenya, Egypt, and Morocco. Let's think about luxury residential property. Our Prime International Residential Index confirms that average luxury house price growth slowed to 5.2% last year. Although with 17% of global ultra-high net worths buying a home in 2022, this was still the second strongest year on record. Some 85% of the 100 markets tracked saw positive price growth led by Dubai, 44% growth, and Aspen at 28%. At the other end of the ranking, markets that led through COVID-19 saw big reversals, including New Zealand's Wellington and Auckland, down 24% and 19% respectively. Nairobi sat near the middle of the table, with 4% growth in 2022. Wealth preservation, hybrid working, and early retirement themes supported resort markets. Sunbelt locations and ski belt locations were up at nearly 8%, outperforming average prime growth through 2022. At the very top of the wealth market, the number of super prime sales, that's $10 million plus sales, in 2022 slipped against the total in 2021, although it remained 49% higher than back in 2019. New York, Los Angeles, and London led the pack in the terms of numbers of sales. The even more rarefied ultra-prime market, so that's $25 million plus market, was dominated by London and New York, with the former market seeing the highest numbers of sales since 2014. Let's think about mobility. One of the legacies of COVID has been a massive growth in the desire for mobility. The 13% of global ultra-high net worths who are planning to acquire a second passport or citizenship is the tip of the iceberg. The boom in so-called digital nomads is only just starting. This promises disruption to outbound countries, destination markets, tax systems, and residential rental demand and office requirements. Competition to attract this new footloose wealth is increasing. Alternatives to Western investor visa schemes are growing, with surging applications in Turkey, for example, as well as more flexible offerings in Dubai, Singapore, and Hong Kong. Singapore's sevenfold growth in family offices is testament to its success in attracting wealth. While education remains a big draw for London, Italy's flat tax scheme is, we feel, a wake-up call for the UK, as a replacement Tier 1 investor visa remains absent and the non-dom regime comes under more scrutiny. Thinking about the year ahead, 19% of ultra-high net worths intend to invest directly into income-producing property, 15% in Kenya, with 13% set to take the indirect route, and again 13% also in Kenya. In terms of sectors in demand, healthcare leads, followed by logistics, offices and residential. Our own forecast for cross-border allocations suggests that offices will lead in the year ahead, with London the top target. US investors will provide the firepower for almost 50% of cross-border volumes in 2023, with strong activity expected from Singapore, the UK, Canada, the UAE and Switzerland. Kenyan investors' top picks for the year ahead are residential, retail and development land. We believe that changes to investment criteria, funding and market trends will drive investor behaviour. Some of the changes we see this year include ESG, where we note the E dominating investor thinking, and there may well be a call to pull apart the criteria and separate the E from the S and the G. Kenyan investors are highly focused on reducing carbon footprint of investments as well as maximising social impact, the top two objectives from our ESG survey. Refinancing with a widening funding gap will see debt funds grow. Grocery markets globally will see disruption, and it means a requirement for 10 million square feet of last-mile fulfillment space in the UK alone. China's reopening means student accommodation demand will be boosted in the UK, the US, Australia and Canada. Thinking about future housing demand, while the proportion of ultra-high net worth set to buy residential property in 2023 at 15% is down slightly from 2022, the high share of cash purchases at 49% will cushion the impact of higher rates and support prices. Markets in demand for Kenyan buyers are Kenya, the UK, US, Canada and Australia. Of the 25 cities we provide forecasts for, we expect 15% to see price growth this year. Dubai we expect to lead at 14% growth, with a huddle of other cities expected to see rises of between 3 and 5% this year. Supply has been a constraint on the market since the beginning of COVID, and we believe that will ease as ultra-high net worths rationalise portfolios, which now average 3.7 homes. Luxury home purchasers need to navigate ever more global rule changes, including a Canadian ban on non-residents buying this year and next, a new mansion tax in Los Angeles, tighter lending rules in Singapore, higher fees for Australia's non-resident buyers, and a new Spanish wealth tax as examples. But with buyers confirming they're actively seeking political stability and transparency of asset ownership, these levies and hurdles to ownership look like the new normal. Finally, we've always tried to take a very broad view of the wealth portfolio. Our Knight Frank Luxury Investment Index allows us to track the performance of prices of luxury collectibles. Our index rose 16% in 2022, faster than inflation. Art was up 29%, classic car values up 25%, and they led the table. And they were propelled by record-breaking sales and some huge and unique collections coming to the market. While rare whiskies only managed 3% growth last year, early adopters will be happy with a 373% 10-year return. Looking ahead, prospects are very good for art and cars, with 59% and 34% of ultra-high net worths respectively looking to invest this year. For Kenyan investors, luxury collectibles in demand are led by classic cars, jewellery and art. There's a huge amount of detail in the report with many more data points which will aid your analysis of the market opportunities and risks. I hope you found that a useful summary of this year's report. Thank you very much for listening.